Hello, and welcome to Dreams to Keys Realty YouTube channel. I am Jalon Strong, the essential millennial realtor of Dreams to Keys Realty. Welcome. Come on in, subscribe to our channel, like this video, hit the notification bell so that you don't miss any content that we upload or anytime that we are live. And also leave questions or comments in the comment section. Feel free to share this video to anyone you know that's interested in this type of content. We love to see more subscribers, and thank you all who have subscribed to our channel. We're going to start with an interesting topic today: student loans, the mispayments impact on home buying. Now, before we get into that, we're going to talk about two things. One being the link in the bio highlight of the week. And for YouTube, it's the link in the description box. The highlight of this week or for this live is Rent Reporters. Rent Reporters is a company that we are affiliated with that offers a service for on-time rental payments to be added to your credit report, thereby increasing your credit score. This is something that is not done by itself. So this is a service that Rent Reporters is offering to renters who are making on-time rental payments. Should you be interested in that or need a boost in your credit score and you don't have that already showing or reflecting on your credit reports, feel free to go to the link in the description box, which is also moving about at the bottom of your screen. And that is beacons.ai/Jalon Strong. Sorry, YouTube or StreamYard is a little slow right now, but hopefully it's not too much of an issue. Now, the next thing we'll talk about is our website's discount code for all of our products. The discount code from March 1st through March 31st at 11:59 p.m. Eastern Standard Time is SISTAH, SISTAH. And with that code at checkout, you can get 20% off all products at our website, which is dtkrealty.com/shop, just as you see it on the screen. Feel free to use that to purchase any of our merchandise, including our My Dreams Have Keys collection, which is available in shirts, baseball style shirts, crew necks, hoodies, and journals. And you never know when we'll add something new. So feel free to shop around on our website. We have a variety of colors. I'm currently wearing the hoodie for My Dreams Have Keys, so I'll let you all see. So feel free to get your own. It is a little chilly today here in Georgia, so you may want a hoodie to just throw on as you're moving about. Now let's get into today's topic. If you've seen the live, there was some technical issues going on, so we had to stop that live. So I have recorded this one to upload later based on that type of technical issue that was going on that day. So what I've noticed is every time I tried to share the screen of the article from Forbes, that it seemed to just cause some delays. And I'm not saying that it's the article itself, but that just seemed to be the trend each time I tried to share it. So I'm going to try another method, which is I save that article as a PDF and we're going to review it that way. And hopefully that doesn't give us much issue. So hopefully you can see the article. And it looks like you can. I'm going to make it bigger. Give me 1 second. I want to make the article itself bigger. So what I think I'm also going to have to do is I don't have the article up on my screen in the back so that I can read it, because the screen that you're probably looking at is also looking pretty small. But I'm going to use the PDF to read from in the background versus trying to move through the whole document like I usually would, which would be my preference. But given all of the issues, we're going to push forward. So the article is titled, "Why Are Credit Scores of Student Loan Borrowers Dropping Up to 200 Points?" It was written on February 25th, 2025 at 11 a.m. Eastern Standard Time by Shahar Ziv. And of course, this is from Forbes at Forbes.com. We're going to I'll read the article and then talk about some points of how it affects the home buying process. Student loan borrowers. So this is, if you're a student loan borrower, this is something that you may have already experienced or you need to be on the lookout of. So just try to hear how it's impacted others and see if this is something you need to watch for and need to take action on. So the article reads, "Credit scores are dropping for student loan borrowers. Student loan borrowers nationwide are waking up to a harsh new reality. Their credit scores are plunging, sometimes by as much as 200 points. As the extended COVID era protections end, millions of Americans face a sudden, brutal reckoning with student loan servicers reporting late payments or other negative marks to credit bureaus. Given the importance of a strong credit score, a precipitous drop of 100 to 200 points has real implications for borrowers. Here's what happened and what borrowers can do proactively and reactively. What's causing credit score issues for student loan borrowers? Millions of federal student loan borrowers enjoyed a rare reprieve during the pandemic. In March 2020, when the economic shock of COVID-19 hit, student loan payments were paused and adverse credit reporting was suspended. Later, the Biden administration introduced a one-year on-ramp period from September 2023 to September 2024, designed to help borrowers ease into the repayment schedule without fearing immediate credit damage. The intention was to give people a break while the economy recovered. Practically speaking, even if borrowers missed payments during this time, those delinquencies were not reported to the major credit bureaus. It was a lifeline designed to help borrowers adjust to renewed economic pressures. However, as with all temporary measures, it was never meant to last forever. From October 2024 onward, any missed payment is reported as a 90-day delinquency, which means that as early as February 1st, 2025, borrowers who haven't resumed timely payments are already seeing the fallout. For many, this wasn't a gradual transition. Instead, credit monitoring services started sending out alerts, and many borrowers began discovering that their hard-earned credit scores were dropping precipitously. Now, I want to stop here and just recap some points. So, yes, during the COVID-19 pandemic emerging in the United States, the administration at the time, which was the Biden administration, did look to try to alleviate some economic pressures. And one method that was used, as the article mentioned, was to, I think the proper word would be forbearance or delay payments of student loan debt. Now, this was never spoken of to be as forgiveness. What's being mentioned here is specifically the pause. So payments were put on pause. And as someone who has student loans and carries student loan debt, what I experienced is not entirely the way this article mentioned it. So for one, during the process from the pandemic to now, student loan servicers changed. So my student loans were moved to another servicer. So that was happening. And from what I could hear from others, that happened to them as well. So when your loan servicer changes, the communication method also changes. For example, my first servicer, I could email, I could upload documents, and I got more of a timely response. Whereas the servicer I was transferred to, and again, this transfer was not a request of mine, it was something being done in the background without my request or permission, even say. So that process changes the communication. And with the new loan servicer, I couldn't email from their website. I couldn't upload things. And to call them would be almost like taking a full day. It could take a full shift, your lunch break or whatnot to even get to someone on the line. And unfortunately, when I experienced getting someone on the line, the information I received still didn't match what was showing. And because I can't email them and because I can't send something, upload something on their website, I again have to go back to calling them to hear something that may not match what I see later. So there's that I experienced. So it's not just, from my experience, it's not just that people were not paying. There was some movement in the background from what I observed that could have impacted the communication. And also, when we say not paying, some people may be on auto payment schedule normally, but when these forbearance periods started, that was paused in the background. So there wasn't like a manual step that someone like myself had to take to create the forbearance period. The forbearance period was done for me. And then if you were not on auto pay, you may have missed that window to start your manual payments. And I'm not someone who has experienced any of these missed payments, but I can see how all that movement in the background, the lack of communication, just in basic things, impacts knowing if you are ready or are supposed to be paying money at a certain time. And if we're frank about where we are in this nation, truth and fiction seem to be communicated in the same methods. So it's very hard for someone to decipher, especially if the loan servicer is not providing the communication in a timely manner. It's hard for people to decipher what's real. And that's unfortunate, but that is where we are in a lot of spaces. So I can see how frustrating that could be for someone who experienced a credit score drop without the communication being there adequately. So that's just my take. Let's get back to the article. This next section says real people, real credit score impact. Confusion and anxiety around plunging credit scores have popped up on social media. Newsweek chronicled the cases of several student loan borrowers, including Roman Henry, who was blindsided when he received an email from Experian informing him that his score had fallen from above 800 to just 608. I will resume making payments in May 2025, and I have no issue paying moving forward, Henry told Newsweek. But the issue is now my credit is ruined. Like Henry blamed the drop Like many, Henry blamed the drop on poor communication from his loan servicer, Nailnet. Outdated contact information and sporadic notifications left him unaware that payments had resumed, and he was now 90 days delinquent. So this article was written in February, and I'm pausing from the reading to just process what we just read. So with Roman's situation, he had an excellent credit score. If it was above 800, that's excellent. And it dropped to 608, which is going to need some improvement, especially if you are in the home buying space, because depending on what loan program, even down payment assistance in some areas, you need a certain credit score, because in this process, in the home buying process, like many others, credit scores are utilized to determine your history and the risk to the lender. So what Roman is saying here, that he had excellent credit, he has plans, but even with this article being written in February, he's also noting that his plans are to start in May. So it's sounding like he might get another late payment mark or delinquency mark on his credit score with this if he starts in May, as this article reads. But with someone that has that type of credit score, and let's say they want to buy a home, this could severely impact the ability to do so in the best terms. For example, one thing that we know about credit scores and credit reports is that many loan programs are looking at the credit report. Your lender will pull a tri-merge credit report, and that report will detail from all three credit bureaus. And what they may look for, not just your credit score, but if you have negative marks, how long ago were they? So if you're looking to buy a home, and let's say the loan program that best suits you is one that has an exclusion that says it will not allow for any late payments within 12 months on your credit reports. And if you have this mark now, then you would have to wait an additional 12 months to use that specific program. Of course, there are millions of programs, hundreds of programs, and hopefully there's another way to get to buying your home. However, it could come with terms that might not be as favorable as if you had the credit report without that mark and the higher credit score. Hopefully that makes sense. Now I'm going to go back to the article. It says Newsweek also highlighted the case of Taylor Scarborough, a 27-year-old San Francisco resident who experienced a similarly shocking turnaround. Her credit card company reduced her limit, and she learned from Credit Karma that her credit score had fallen by over 150 points. This was the first and only indication that something was wrong, Scarborough explained. Nelnet never sent me a 30 or 60-day past due notice. She too found herself caught off guard, unaware that her account had already been flagged as delinquent. Scarborough told Newsweek that the drop in her credit score has had an immediate and devastating impact on my financial stability. My credit score was slashed by $8,000, limiting my ability to cover essential expenses. I'm going to pause again here because what I noticed between both stories is that the loan servicer is Nelnet that's being described here. What I also noticed is that there were different ways that they received notification that something was wrong. With Roman, it was Experian informing him that his credit score had already dropped. With Taylor, it was her credit card company reduced her limit and Credit Karma told her that her credit score dropped. So Nelnet seems to be a loan servicer of concern when it comes to this issue, just based off of this article. I am not with Nelnet, so I don't have that specific experience. But just reading this article and how it's written, it appears that Nelnet is one that if you have that loan servicer, you would definitely want to check and watch for any issues with your payments and your credit reporting. Now, the next part says the mechanics of the credit score fallout. Credit scores are more than just numbers. They're the key to one's financial reputation and unlocking financial opportunities. A high score can mean lower interest rates on mortgages, better credit card offers, and even job opportunities, as some employers review credit history during hiring. When scores drop from the high 800s to the 600s, it isn't merely a cosmetic blemish. It's a fundamental setback. Lenders view these lower scores as indicators of higher risk, often resulting in higher interest rates or outright denials for loans. Once a borrower misses a payment and the account reaches 90 days past due, the delinquency is usually reported to the credit bureaus. This negative mark can remain on a credit report for up to 7 years, severely limiting future borrowing potential. The ripple effects extend beyond just loan approvals. Reduced credit scores can lead to higher premiums on insurance policies, less favorable rental agreements, and a diminished ability to invest in one's future. I want to pause here as well because this article brings up some great points. And of course, here at Dreams to Keys Realty, we focus on the home buying process mainly based on our mission. But this article does bring up some great points that the credit score and credit reporting issues impact other areas, your insurance policies, employment, hiring processes, impacting your credit card limits, as we saw with Taylor's example. And also, if you're in the rental space, it impacts you as well. It's not just limited to those that are in the home ownership space. So there are so many places where this shows up and has an impact, which can increase terms or cost more fees for people in various pockets of their lives. So it's not something that's just limited, it's temporary. It can be something that takes some time to undo. So let's continue to read. The communication breakdown causing credit score damage. At the heart of this debacle lies a systemic communication failure. Many borrowers reported that their loan servicers had outdated communication information, old email addresses, outdated phone numbers, and incorrect mailing addresses. As a result, critical notices about payment resumption and impending delinquency never reached these individuals. Instead of a gentle reminder, borrowers learned about their delinquency through impersonal emails from credit bureaus or sudden cuts to their credit limits. I want to pause here again because, like I mentioned before about the communication, and this does highlight some of the communication issues. If your loan servicer changed and their communication styles are different, it also can impact how you update your information. So just to kind of play an advocate for the borrowers here, if you're having all this movement in the background, and sometimes when your loan servicers change, there's a delay before you can do certain things, before you can update certain information. And with this pause being in effect, it could also be a thing of out of sight, out of mind, because you haven't had to address the loan payments in some time. And also with that movement going on in the background, the communication just can appear to not be there or to not be a critical issue at that point. So there's a lot that plays into the communication here. I think if you're someone who doesn't have student loans or did not have it at the time that we're discussing, then you may feel like, oh, they should have updated their information and they should have updated their mailing addresses. That's on the borrower. But sometimes when those loan servicers move your information, they don't move your current information. And also, if they don't outline the best ways to update your information in their processes, such as having poor communication or a website not fully developed, then it also impacts that borrower and how they're able to make sure their information is up to date. So there's a lot of things that can be impacted here. What we see and we're about to read with this next portion is NailNet seems to be mentioned quite often in this article. And I'm not sure if that's by intention of the writer or if that is just the nucleus of this issue, but we'll continue to read. So Henry, the student loan borrower, admitted to Newsweek that after logging into NailNet, my email on file was outdated, my mailing address was outdated, as I have moved 6 times since 2020. And that looking back, I did receive a couple of phone calls from what I now know to be NailNet, but I never answered as I believed them to be of the 10 plus spam calls I received daily. Another borrower had similar sentiments. I assumed NailNet would contact me when payments restart since the dates were extended multiple times over the pandemic. They also had the wrong address, email, and phone number from long ago. My correct address was on my credit report. The transition from the on-ramp to regular payment schedules was supposed to be seamless, but has proven otherwise. Even when borrowers did receive a few phone calls, often dismissed by student loan borrowers as one of many spam calls, the lack of clear, consistent communication left them vulnerable to falling behind on payments. Ooh, excuse me. So that brings up another outlying factor, spam calls. If you are someone who has a bill or debt, do you anticipate only receiving communication by calls, or do you also anticipate something maybe in the mail or through email? Now, granted, the references here from the examples being mentioned from Henry and Scarborough are that even though their correct address is on their credit report, Nailnet had old information. And again, sometimes when you transfer or your information is transferred through different loan servicers to another, they don't transfer the most up-to-date ones. So you have to double check. What I will say is that I haven't been with Nailnet in years, but with my current loan servicer, when the time came for these payments to be resumed, they said, hey, they're about to be resumed. Make sure your information is up to date. Now, if your information in their system was already outdated, I could see where you would not get that. If they called and you mistaken it for a spam call, I would have hoped that they would leave a message saying this is Nailnet and this is why we're calling. So it's interesting that for both parties, it seems that maybe the calls were made, but they weren't distinguishable enough to know that this was Nailnet. Now, usually your loan servicer doesn't really call you. Often it feels like, at least in my experience, that I would call them versus the other way around. And the communication comes in some other form, like email. So that's interesting to know from these borrowers. And again, they're mentioning their experience from Nailnet. Now I'm going to continue reading. We're almost done with this article. So this section is called What Student Loan Borrowers Can Do to Cure Credit Score Damage. For those who have seen their credit scores suffer due to missed student loan payments, there are steps you can take, albeit with no guarantees. 1. Request reactive forbearance. The College Investor highlights that some servicers like Nailnet offer borrowers the opportunity to retroactively place their accounts into forbearance, thereby preventing further damage. However, this does not erase the delinquency already reported to the credit bureaus. With this option, it seems to me that, and this is just my thinking, that if it doesn't remove it from the credit bureaus, but you have proof that they have retroactively placed it into forbearance, then maybe you can request that from the credit bureaus individually. So that could be an option, just my thinking. The next option they have in the article is goodwill removal request. Borrowers can ask their servicers for a one-time courtesy removal of the 90-day delinquency mark. While not guaranteed, there have been cases where servicers have acceded to such requests. Given the widespread confusion over the end of the pandemic protections, borrowers have nothing to lose by contacting their servicers and politely pleading their case. So maybe if you were to combine the first two from the article, the request retroactive forbearance and the goodwill removal request, you could go solely through your servicer to have that fixed if you have the 90-day delinquency mark. So that could be an approach to take, or two approaches to take. The next one in the article is to dispute errors. If you believe your delinquency was reported in error, perhaps due to miscommunication or administrative mistakes, file a dispute with Equifax, Experian, and TransUnion, which are the credit bureaus. So those are individual disputes that you could do with the credit bureaus. The next option is to enroll in an income-driven repayment plan. If your financial situation makes timely payments challenging, consider enrolling in an income-driven repayment plan. Not only can these plans lower your monthly payments based on your income, but consistent on-time payments under an IDR, income-driven repayment plan, can help rehabilitate your credit score over time. Note, as of March 2025, all IDR plans are now blocked for 3 months by the Education Department. So, yes, if you decide that the current plan that you have is a bit challenging, or your current payment is a bit challenging, enrolling in an income-driven repayment plan could be an option. Like this article mentioned, that request or trying to enroll in these types of plans has been blocked currently because this video is being made in March. And as of March of this year, 2025, all IDR plans are now blocked for 3 months by the Education Department. So maybe around, that would be August, you would be able to enroll, hopefully, again. The next recommendation is to monitor your credit. Regularly review your credit reports through annualcreditreport.com. Early detection of errors or unauthorized delinquency report is crucial for timely correction. You can often set up alerts, including through your bank or credit card company, for changes to your credit. And we have talked about monitoring your credit or reviewing your credit here on this channel. If you're interested in our take on that, please go see the video that's titled Bingo for Home Ownership Step 1, which is reviewing credit. Update your contact information is the next recommendation they have in the article. Ensure your loan servicer has your current email address, mailing address, and phone number. This may seem obvious, but many borrowers have fallen victim to outdated records, making it nearly impossible to receive timely payment notification. And I would guess that that might be the hardest hurdle for those that were mentioned in this article as examples, because it seemed like they noticed later on that they did get a phone call from Nailnet in particular, but they thought it was spam. And I guess now that they want to call Nailnet, they realize, oh, there was a missed call from this number or an unanswered call from this number. So make sure that you have your information up to date with your loan servicer. Even if it changes, go to their website and see how to make sure it's up to date and how to get that rectified as soon as possible so that you don't have issues like this. The last recommendation under this section is take active steps to rehabilitate your credit. Borrowers whose credit scores have been impacted should focus on paying future bills on time and keeping their credit utilization low. These two factors make up close to 2/3 of what impacts one's credit score, and consistently strong marks should help improve scores after a few months. So yes, once you have an issue on your credit, making sure that you minimize credit issues, negative marks, that you are doing the things such as paying your bills on time and limiting your credit utilization. And I will say that apps like Credit Karma will help to show you your utilization, and also you may have some features with your credit card company that help you to see your utilization and the impact on your credit score. And this is the last section of the article that reads the upshot for student loan borrowers' credit scores. The end of the federal student loan on-ramp period marks a turning point for millions of borrowers. A moment when the protective shields of deferred credit reporting is lifted, exposing them to the harsh realities of missed payments and negative credit marks. To prevent their credit scores from dropping precipitously, borrowers must proactively safeguard their credit, update their credit information with student loan services, and dispute erroneous reports. So that is the end of how this article reads. And I'm going to remove the article from the screen. Did you all learn anything from that article? I know that I was reading it in the background while the face of it was on the screen, but hopefully you learned why credit scores were dropping related to the student loan process changes or student loan repayment process changes. And hopefully you were not impacted. But should you have been impacted, or if you were impacted, I hope that this article and the discussion that I presented help to give you some things to consider to mediate those concerns. If you're someone who was not impacted, but you're thinking in the back of your mind, I'm not sure if my loan servicer has my most up-to-date information. I don't know what my credit report says about me and about my student loans lately. Maybe I need to check. Maybe this is the sign for you to do just that. Of course, as I mentioned before, go to our video from our series on bingo to home ownership, where step 1 is review credit. And we talked about going through the annualcreditreport.com site. We talked about the credit bureaus. So just make sure that you review that video. It gives step-by-step instructions on how, whether you're concerned about your student loan missed payments or you're looking to just review your credit in preparation for the home buying experience or any other experience where credit is a factor, you can use that video to help you to understand your place in your credit report and how to improve it, what's on there, how to get your credit reports, and so much more. Well, I hope that if you have any questions or concerns that you will leave them in the comment section. We will review them as we see them and answer them appropriately. I thank you all for sharing your time with me and dealing with these technology issues with me, but I hope that you still were able to gather information from today's video, from the article, from my thoughts on the article and on the topic. And hopefully it helps you or someone you know who may be impacted by student loan missed payments following the on-ramp period being completed. So if you have any questions or comments, leave them in the comment section. Please like the video, subscribe to the channel, hit the notification bell, and share the video to those that you know are interested in the home buying process, student loan information, or just any information that we share on our channel. I hope to see you in the next video, and I will say bye-bye for now.